good afternoon, everyone, and a very warm welcome to you. This is part of the Edison Open House Transport Futures 2021 event. My name is Mike Turner, and I'm a partner at Latham & Watkins, the global law firm here in London. I sit in our emerging companies group, and what that does is to look after companies and investors from startup all the way through to exit and IPO in the context of what we're going to talk about today, operating exclusively in the technology and the life sciences spaces. Today's panel is here to talk about the growth capital market ecosystems and to provide you with a transatlantic perspective. No panel is great without great panelists, and I'm delighted to say that we've got three terrific panelists with us today. I'm going to ask them to introduce themselves because they'll do so much better a job than I will. So let me start with you, Jason. Jason is EVP at OTC Markets Group. Jason?
Thanks, Mike. Yes, Jason Palford's Executive Vice President, Corporate Services at OTC Markets Group. OTC Markets, in essence, is home to many thousand international securities that choose our market in the U.S. to access U.S. investors and to be able to have a security cross-traded in the U.S. without the cost and complexity of being listed on a national exchange. So we are the home to the likes of Roche, Adidas, Heineken, Tesco, Marks and Spencer, as well as a number of early stage growth and developing companies from around the world that choose our market, again, to access U.S. secondary liquidity as well as investment.
Terrific, thank you, Jason. And let me turn to you next, Marcus. Marcus is head of Ames and the UK primary markets, the London Stock Exchange Group. So Marcus.
Thanks, Mike. So as you said, I head up the UK primary markets team at London Stock Exchange. So my team and I focus very much on supporting our existing companies on AIM, our growth market, and our main market, and also talking to a lot of private businesses that are thinking about their future funding options. Today, I'll be probably focusing more on AIM, our growth market, which has been in existence for 26 years and has over 800 companies admitted to it, and look forward to the conversation today.
Terrific. And last but certainly not least, we have Rosh from Silicon Valley Bank, Head of Corporate Finance at SVB. Rosh.
Thanks, Mike. Hi, everyone. My name is Rosh Vijayarathna. I head up the corporate finance practice for Silicon Valley Bank. Silicon Valley Bank is a full commercial and investment bank completely focused on the innovation ecosystem. All we do is work with technology and life science companies and their investors from very early stage companies all the way through to some of the largest multinational corporates. We've got over 3,000 people globally and over 400 people now based in the UK, where I'm based in London. Corporate finance focuses specifically on later stage companies and more targeted on those that are at that inflection point that are going through sort of VC growth capital and potentially looking at the next stage of what their capital structure might look like, whether that's public markets, private equity, M&A, or any other routes that they'd be looking to exit. But delighted to be here with these guys and looking forward to chatting with them.
Thank you, Rosh, and thank you all. And let's dive straight into the questions, if I may. So let me kick off with you, Marcus. What have been the key factors in Ames' ongoing development, and what are the takeaways from the capital raising activity year to date?
So, Mike, we've been operating AIM for 26 years, as I mentioned earlier, and it's been. I mean, I've been part of that journey for quite a long time, and it's been fascinating to see actually the way that the market has matured, and also the relationship between the public markets and the private markets. And we spend a lot of time focusing on trying to make that transition for companies from private to public as seamless as possible. In terms of some of the key features that have made AIM successful or have been part of its sort of maturity, I guess a lot of companies come to a capital market to raise capital. So the fact that AIM is part of London Stock Exchange Group, is based in London, and therefore has the backing of a very deep and broad pool of of investors, from retail investors through to high net worth individuals, through to some of the world's largest sort of institutional investors, has been one of the main reasons for its success. I think one of the other things, we've always been very dedicated to make sure that AIM represents a very broad set of companies. So we have companies from a broad range of jurisdictions, from a broad range of sizes. So AIM can support companies from low tens of millions to companies that have grown on market to the single billions. So I think that diversity, and also the diversity of sectors, has been really important. One of the reasons that companies will often come to a public market in addition to raising capital will be that they want to have a liquid share price. So we operate a broad range of trading markets. We've seen liquidity grow over the years. But also, I think being public often raises the profile and visibility of a company. So being part of a peer group of 800 plus companies, I think, is really important to businesses to raise that credibility and that profile. I think you talked a little bit about sort of trends year to date. It's worth thinking about the last 18 months. We've obviously been through globally a period of real readjustments because of the pandemic. And I think in many ways, public markets really came to the fore globally last year. Across our markets, we saw over £50 billion raised. And actually, that capital raising was primarily companies on market going back to their investors and raising further rounds of capital. And I mentioned this sort of at the outset of this session today, because to me, that really underlined the long-term access to capital that the public markets can provide. And from an AIM perspective, what was great was that we saw companies from relatively small businesses right the way through to some of our largest companies raising further capital, sometimes to strengthen their balance sheets, sometimes actually to be able to make acquisitions and to put themselves in a good position as economies recovered. So as a sort of context, the very high levels of capital raising we saw last year has then turned into an increasing number of new companies joining the market. So on AIM this year, we've had 18 new IPOs that between them have raised about £800 million. The further capital raising, though, has continued with a further £2.2 billion so far raised by AIM companies alone through the market. So, we've seen investors with plenty of capital to deploy. We've seen both new and existing companies continue to raise capital. We've also seen, a trend in the number of technology and healthcare companies joining the market. But the thing that underpins all of this is I think investors are really looking for growth. They want to back growth companies, and they often turn to growth markets like AIM to find those growth opportunities and the next generation of businesses that are going to grow going forward. I'm sure we'll pick up on sort of a number of those themes, over the coming sort of 45 minutes. But that's sort of a potted history of where we are so far.
That's terrific. Thank you very much. And let's cross the Atlantic, if we may. And Jason, a question for you: how does the smaller growth company public environment currently look in the US?
Well, I think we're seeing very similar things to what Marcus is talking about. I think when you look at our markets, and certainly our two primary markets, our OTCQX and QB markets, we've seen, actually, as of this morning, 298 companies already this year come to our markets, and close to 80% of those are international. And so I think as you're looking at what companies are looking for, it's enhancing that secondary liquidity, as Marcus said, but also looking for new investment opportunities. And the US is a great market in terms of the breadth and depth of the types of investors. The US is still one of those markets where there's individual investment. You have the investor group that's invested in their 401k through the big stock funds, but that are still doing direct investment, whether it's through their Robinhood or their E-Trade accounts. The growth of family offices has been something that we've seen take off over the pandemic, and companies from around the world using our markets to have that secondary trading venue, but to do it in a way so that they can access family offices, retail, smaller institutional investors, and raise additional growth capital. We look at our market as kind of like the public venture capital market. And so a unique alternative for companies in myriad industries and sectors looking to access kind of that breadth and depth of investment in the US.
Great. And look, before we get to you, Raj, let me just ask a question to Marcus and to Jason, really as a follow-up to what we were just talking about. What mechanisms can companies employ once listed to foster liquidity and broaden their investor base by type and geography?
So I think for us, I'll kick off because we're kind of a secondary piece in all of this, right? For us, what we're seeing is we're not a primary IPO market. Ames does a great job. London does a great job. And we see companies from exchanges from all over the world. What companies do with us is they use our market as a secondary trading venue to give investors access to a US dollar quote in US time zones to be able to access those companies from a US market perspective. And so what we see companies is doing, again, in markets around the world, primarily Ames, we've seen a number of companies raise money on Ames, use the benefits of Ames in London to access that pool of capital, but then put a secondary quote in the United States. A lot of that liquidity comes out of the United States and flows back into London through the way the trading works on our market. And it opens up to that pool of investor that maybe otherwise would not have been able to go direct into a foreign market. And then from there, you're looking at private placements and other vehicles through which you can raise additional capital from, again, the family office universe or the institutional investor.
Marcus, do you want to add to that?
Yeah, sure. And yeah, profile, visibility, and liquidity are things that we could probably sort of spend half a day sort of talking about. But I do think companies have become more sophisticated, and I think technology has clearly enabled that as well. So we see companies even prior to IPO spending a lot more time educating investors about their business model, and really thinking about having a diverse set of investors. And I touched upon this in my opening remarks. I think one of the big advantages that Ames provides is that it's a growth market that really does provide access to individual investors as well as some of the world's largest institutions. And we've worked very hard at making sure that that's the case. And actually over the years, I've had a lot of sort of support from government, from policymakers. So there are a number of tax breaks, for example, that encourage people to hold shares in smaller growing companies. And so we also have some sort of tax incentivized investors that also support capital raising and liquidity. And then as an organization, we've spent a lot of time, particularly over the last 4 or 5 years, making sure that we provide products and services to companies. So we have a division called our Issuer Services division that works with companies to support them to make sure that, for example, through our own corporate website, which gets millions of individual investors visiting it to find out about companies, we make sure that each company has got a company page where they can embed some of their own investor relations material and videos, and we can really try and augment the distribution really that companies have. And then we're seeing companies really thinking about treating retail equally to institutional investors, both when they're doing capital raising. So one of the themes that we saw last year was a lot of companies not just doing an institutional placing, but also offering a proportion of that to their existing retail investors. And I think that's because there's a recognition that treating all of their investors equally and really bringing retail into the fold helps with profile, but it also really helps with liquidity. And actually, sort of prior to this call, I was just sort of quickly looking at the liquidity stats year to date. And I think a result of all of that and the fact that we're seeing a lot of investor focus on growth stocks has been that, we've seen the highest levels of daily trading and value traded this year so far than we've ever had. So, I think there are lots of sort of positive signs there.
I think that's a good point, Mike. If I just add, because we talked about COVID and the kind of what's happened from COVID, I think retail is the interesting piece of that, and where companies prior to probably didn't give retail the focus they would have traditionally. Seeing companies come in and looking for ways and really putting people in a position to focus on the retail investor. Similarly, we've seen, I think last month we did $60 billion in dollar volume. Much of that is that new retail investor. So that interesting dynamic from a corporate perspective, as companies that used to shy away from retail and not want to look at a retail investor are really rethinking that strategy in the post-COVID world.
Hello, we've seen a huge amount of column inches in the press about retail investors recently. And how do you think you can marry increased retail participation with appropriate levels of investor protection? Probably a question for both of you.
Yeah, so look, we've always, the way that we operate AIM and always have done is that it's the same regulatory structure for all investors. So we regulate it on the premise that an individual should have the same level of access to information as an institution. So primarily the way, I guess there are two ways that you protect any investor. One is to make sure that there are good levels of disclosure so that any investor can make an informed investment decision and that all investors receive that at the same time. And then the second actually is liquidity itself. One of the ultimate sort of protections that any investor has got is that they're able to trade in and out of securities. And I think that's been one of the themes that we've seen, where actually the institutions have increasingly been saying, look, when we make an investment, even if we want to be a long-term shareholder and have the view that we're going to hold a stock for 5, even 10 years, we want to know that if we need to trade out, we can do. And so the institutions themselves have been saying to us, look, it's important to us that there's a diversity of liquidity in the market and that retail are involved. And ultimately, the more liquidity you've got in a company's stock, the lower that company's cost of capital, because the investors will require a smaller discount to invest because they know they can get out more easily. So I think there are a number of factors really that, particularly as AIM has matured, we've seen that that mix of retail and institutions come together, in a very symbiotic way. And I think also we've taken a very practical approach to regulation. So back over sort of 10 years ago, and this will sound really basic now, given that everyone sort of does it, but we introduced a rule that all AIM companies needed to maintain an investor relations website where all of the key announcements and documents and biogs of directors, all of that core information that an investor needs to make is freely available in one place. And that was really designed to help individuals invest on the same basis as institutions.
Jason, do you want to add anything?
Yeah, I would add, look, I agree with Marcus, right? It really is about disclosure and transparency. I think in the US, our markets are SEC and FINRA regulated, and both the SEC and FINRA have been undergoing a review of how do you protect the retail investor. There are rules in the US. The most recent is a rule around what we call 211 reform, which talks about what a company has to disclose in order to maintain a public quote. Those rules have been redrafted. The SEC passed the new rules, which go into effect September 28th, and really give us kind of that quasi-SRO status to be able to review that information, put it out into the public market to ensure that investors have that kind of level of disclosure and transparency. And if they don't, those shares can no longer be publicly quoted in the US. You overlay on that the SEC exemption for international companies, something sexily called 12G32B. which gives companies that trade on AIM or the London main board or Australia or anywhere the ability to trade on our market with that exemption, so long as they're making their information publicly available in English in a public market. And so you marry those two together from an international perspective, with us kind of as the aggregator, distributor, and public venue for making sure that transparency and disclosure is available. And you really go a long way to we always say sunlight is the best disinfectant, making sure that investors have the information that they need. And then I agree with, Marcus as well, liquidity, institutions coming in, being able to see a public price. I think WeWork was a good example of things that can go wrong when that level of transparency isn't there. And so we work very hard to make sure that we're providing it.
Terrific. And Raj, can I come to you? As you think about your world, which is very close to my world, looking after a lot of the fast growth companies in the UK and Europe, I don't know about you, but I'm seeing a huge increase in the dialogue around the public markets opportunities this year. No doubt caused a little bit by the SPAC and de-SPAC market, which we'll come on to talk about. But first question for you, how can capital markets regulatory reform in the UK and the US make the public markets more attractive to those growth companies?
I think, Mike, you're absolutely right. I think the public markets, especially in technology and life science, are going through an absolute purple patch at the moment. I think we've seen in the UK certainly 12 IPOs versus sort of 5 in the last 5 years altogether. And so we've seen twice the number of IPOs in the first 6 months of this year compared to the last 5 years, which is fantastic. And I think in a lot of those examples, we're seeing a lot of those companies already sort of bend the boundaries of what we've typically seen in the UK. I mean, we saw it to start with the Hut Group last year with voting rights. We've seen it with Darktrace with the 10% float. And we're starting to see companies IPO in a similar sort of way to what we've seen in the US when it comes to voting rights, the amount that they can actually sell. And so having a bit more flexibility with regards to what they can and can't do is only making places like London more attractive to all sorts of technology and life science and innovation companies, both domestically and internationally. And we're seeing that sort of mirrored across Europe as well. And I know we're coming on to the SPAC market as well, but some of the noises and hopefully reforms that we're going to be seeing later in the year will mean that the UK and Europe, or the UK certainly, will have more flexibility with SPAC options, and with some of the changes that we're potentially seeing in the US with regards to safe harbor on some of those M&A transactions when a company de-SPACs and they can essentially talk about their forecasts. We'll be able to learn from what's happened in the US and the reforms that they make. And whilst we might be following what's happened there, hopefully we'll get the best of breed in terms of understanding all the things that have worked fantastically well with SPACs and some of the things that perhaps just need tightening.
Yeah, and I think let's use that as a segue into something which I suspect we can't avoid talking about, which is the what I'll call the relative SPAC markets across the Atlantic. I think we're at a very interesting moment in time with this panel, in that the US SPAC market has had something of a slowdown, which Jason, I'll ask you about in a second, caused largely by some of the regulatory scrutiny that the SPAC market has been put under. The European markets are really just getting going, and I think we're enjoying an interesting dynamic, which is that the Euronext got very quickly off the marks, and Amsterdam was the big winner for SPAC listings. Now London is deregulating, and I know through personal experience there are a number of SPACs lined up to go as soon as the LSE and the FCA are ready. And so I think it's a very changing market. There's a huge ecosystem dynamic, if I could put it that way, as well, where European investors, the European tech community, is super keen to see the de-SPAC market to European SPACs really proliferate as well. So it feels to me like we're just about to enter a very sort of healthy transatlantic sort of competitive scene where people can really make very genuine choices between the two sides of the Atlantic. But Jason, just paint a picture for us, if you would, a little bit of what has happened in the US, why the slowdown, and where the regulatory position now sits.
Yeah, Mike, I think everything you do now when we talk about the US, you kind of need to point to the change at the SEC, right? I think underlining a lot of what you're seeing in the US right now is that Gary Gensler has now taken over the SEC and is doing a thorough review of a number of things, cryptocurrency obviously being one, SPACs being another, public markets and retail investor protection. All of that is kind of under the purview of the new SEC commissioner. When you're looking at SPACs, clearly through the COVID period, there was the SPAC frenzy, and I'll call it a frenzy. And you know it's a frenzy when huge amounts of money are going into SPACs as a function of a famous person being named on the board. And I think what you're seeing now is kind of a pullback to kind of take stock of in the kind of guise of investor protection, but also the valuations and where the money is coming from, to see if just to kind of review it and put some boundaries on it. Clearly valuations are high in the US. SPACs, as you know, right, if you don't invest in something after a period of time, you kind of have to return the money. And I think there's the deal frenzy that goes with that. And so I think we're hitting the pause at an interesting time when the rest of the world is kind of putting some better boundaries around those markets and becoming more competitive, as you said. I do think what SPACs, and I'll put SPACs in with the rise of direct listings, that kind of went with that, and some other options around entering the public market. What it points to from an early stage growth company perspective is that, at least in the US, the main board kind of weren't necessarily fit for purpose in terms of entering the public markets. And so investors were looking for alternatives, and the market always evolves in a way to support those alternatives. And I think the rise of SPACs, direct listings, and the like, reverse mergers, is something that's been going on for a while, point to the fact that companies want to enter the public market. They want to be able to access, whether it's public venture capital or other capital types. But the process of listing in the US on the NASDAQ or the New York Stock Exchange wasn't necessarily meeting those needs. And so I think that's part of why you saw kind of the rise of the SPAC movement here in the US.
Yeah, and Marcus and Rosh, just as we think about things from this side of the Atlantic, I think one of the one thing we can't escape is that a lot of the faster growth but younger European tech and life sciences companies now have the ability to think about the capital markets through a SPAC combination. And it is a little bit alarming to me that some companies are going out for a Series B or a Series C private financing and suddenly finding themselves talking about going public in a very short space of time. And Marcus, it is very different from the IPO. London's quite helpful to smaller, earlier stage companies, particularly in the technology and life sciences sectors, particularly with the AIM market. And I just wonder how you both think about that dynamic, because I think it's going to influence well, certainly the medium term and the long term effects of and impact of these SPACs, of these companies going public via SPACs.
So, Mike, I'd say a few things. I mean, first of all, one of the reasons that we've operated AIM separately to the main market for the last 26 years is to be able to offer a differentiated and a tailored environment for smaller companies. The whole regulatory model, and we have this concept of nominated advisors, which are there to partly shoulder some of the regulatory burden, but to really be there as a company sort of trusted advisor. One of the reasons that we've developed and stuck with that model, which is differentiated and distinct from the main market is to really provide something that is tailored to the needs of growing companies. And I think, therefore, it's no mistake or no coincidence that we've seen companies this year like Tiny Build, Bellascura, Trellis Health, actually US businesses that probably would be too small to IPO directly onto New York Stock Exchange or NASDAQ, coming directly to AIM and IPOing on Ames. So particularly companies like Bellascura that has got a 56 million pound market cap and they raised 17 million at the point of IPO, and that's sterling. We do offer an environment for growth companies that really is, I think, unparalleled in many ways. I think also we don't expect to see as many SPACs in Europe as have occurred in the US. I think Jason made a really good point about direct listings and SPACs, in part being a response to a US market dynamic where it has been harder to do non-deal roadshows, to invest, to attract investors prior to IPO. And I think, therefore, the price discovery mechanism hasn't been quite as good in the US as it has in Europe. And I think, therefore, we've seen for many years sort of very big first day pops that have left a lot of founder shareholders, VCs, private equity houses thinking that they've actually left a lot of money on the table. And we've seen that to a lesser extent in Europe. And so I think, therefore, there aren't quite the same dynamics. That said, as you've rightly highlighted, we are seeing an increased appetite and interest. And for me, actually, one of the very positive outcomes of just the amount of column inches and the level of commentary on SPACs in Europe has been, I know firsthand companies that have thought about coming to the public markets via a SPAC because of the commentary. They've then looked at the mechanics, they've analysed it and thought, well, actually, we're going to have more control over the process and what our shareholder register eventually looks like if we do a traditional IPO. So they've had their appetite whetted by the SPAC commentary, and now are just coming through and doing a traditional IPO. So at the core of all of that, I think we've got to make sure that the capital markets provide a range of choice for companies, and that we don't have that sort of hard cliff edge between being private and being public. And so
I think that's gone, hasn't it? And I think that's been the really interesting dynamic that we're seeing this year. And then, Ross, you must be seeing this all the time in your conversations with growth companies, correct?
Yeah, and just to echo a couple of things Marcus said, I was really, really happy to see some tech companies that probably don't normally get the headlines come onto AIM. You've got companies like PensionBee, ActiveOps, Dynomi all come to the public markets via AIM, and it's really nice to see those companies because they're not big market cap, but arguably absolutely the right things for them. But the interesting thing about SPACs, and everyone's got a different view on it, and it's really, really interesting. If you're a founder and you want to look at a big event for your company, whether you think you're ready for it or not, and I say ready because we're seeing a lot of early stage companies talking about SPACs, as we've just discussed, you're probably thinking about two or three crucial things. Is what's the valuation that I'm going to get? What's the certainty of that valuation? Going back to the price point, am I going to get good certainty of that valuation? And what's the level of control me as a founder or my management team going to have over the company coming out the other side? And when you're weighing up those sort of three things, you've got a range of options from private equity where you've got absolute certainty of valuation. You're probably not going to get the biggest valuation, but you'll get a good valuation. You won't have any control over your company, but that might be absolutely the thing that you want to do. And to the other extreme, you've got IPOs and direct listings where arguably you can still have a massive amount of control for the business, but you can potentially get the best valuation, but there is always going to be a bit of risk with that valuation. SPACs almost fill that void in the middle, where you've got, depending on which partners or sponsors you're going to go with, you suddenly get a range of valuation options and you get a range of control. And so it does feel an interesting void. That's not to say that of the 230 SPACs that IPO'd in the US and the 250 that hit the markets in Q1 this year, that they're all going to find the right home for the right companies. But what it does do, to Marcus's point, it gives a range of options all the way from IPO, direct listing, SPAC, sell to a corporate, or sell to private equity, or continue raising privately. And so you've got just another option there. And so, yeah, absolutely. And I think we spoke about it last week that companies are, I think we said dual tracking, but it was actually tri-tracking or quadruple tracking, because they're looking at an IPO, they're looking at direct listing, they're looking at SPAC, they're looking at selling. And so, yeah, companies have got options. And as long as they've got the right people around them and they know exactly what they want to do, then hopefully a majority will make the right decision. But we will see some car crashes as a result of some SPACs that shouldn't have come to market. That's inevitable. You've got at least 500 vehicles ready to acquire companies, some of which are too early to hit the public markets and some that are absolutely perfect. PaySafe hit the public markets again via a SPAC quite recently, and hopefully will be absolutely the right thing. But I think we're already seeing some of the early stage frontier type companies come to the public markets via SPAC and probably not performing as well as their investors thought it would.
One of the, I guess, one of the drivers here is the search for liquidity, and we've got one more interesting dynamic in the market at the moment, which is that we have levels of growth capital which are we have not seen before. I just worked on the closing of a funding round last week, the Northvolt round, which I think was Europe's largest ever private financing round, a $2.75 billion round. And it's just, oh, and of course, all of these rounds, these later stage rounds, can provide terrific liquidity opportunities for earlier stage investors. Interestingly, a lot of the earlier stage institutional funds are choosing to sell down at least 50% of their position in these later stage rounds now, because they're seeing the 8, 10, 12x return just round to round and saying, well, that's a pretty good return for my fund. I'll take 50% off the table now, thank you. What are you all seeing in terms of what's directing the liquidity conversation for the companies you're talking to, and how that compares, market to market and from the private markets to the public markets? Now there's really more choice, I'd say, than there ever has been. That's for anybody.
I don't mind having a go first. So yeah, I think we all know, and I think it's probably worth setting the scene, that we have unprecedented levels of private capital in the markets. That's been the case for years, ever since we've had the sustained low interest rate period. In terms of Europe, we've seen inbound investment from venture capital and private equity hit record highs every single year, I think, for the last 5 years. Right now, there's $38 billion worth of venture capital dry powder just sitting there waiting to be deployed off the back of record years of investment. And we're going to see a record year again if we continue the run rate that we've seen up to June. And so you have a massive supply of capital, and that will always, to a certain degree, drive the conversation. Off the back of that, you've got fantastic companies being generated in the UK and Europe. And so you've got great demand as well as great supply. And everyone is pushing for high returns. And like you said, everyone's looking for 10x, 12x returns, if not more. And so companies are being challenged all the time. And almost SoftBank set the scene whenever they did it sort of 3-4 years ago to say, look, if I give you $2 billion, what are you going to do with it? How are you going to double down? How are you going to triple down? What territories are you going to go into? And then you add every fund racing to keep up with SoftBank. And then you've got someone like Tiger Global, on the other hand, who are just all about velocity and getting as many deals done for whatever valuation within reason. And all of a sudden, companies are being hit left, right, and center by investors saying, all right, show me a plan, or give me your thoughts on how you would triple the size of your business in the next 2 years if we gave you X. That's going to drive significant conversation. And when you see the example you gave, Klarna raised $1.1 billion, MessageBird raised 900 million euros. Rounds are getting larger, fewer but larger rounds, especially in this late stage. And as we see companies potentially getting a feel for what their valuation is going to be like moving to an IPO over the next 6 to 12 months, you can see that trend continuing.
Yeah, and Jason, Marcus, just start with you, Jason, in thinking about the North American markets, what are you seeing in terms of the liquidity debate, if I can put it that simply?
Well, I think what we're seeing, and we're probably at the lower end of the, we're not really talking to the unicorns and the big names out there. And I'll take our own company, right? We went to market 15 years ago as a direct listing, specifically because our investors, wanted to have the optionality of being able to exit and to know what their investment was worth. I think as we're talking to companies, we're seeing those similar conversations. Is we don't necessarily, we want to be public because we want to give our investors the optionality. And many of the companies that we're talking to are not, like I said, the unicorns where they're going to have that big blowout, or they're going to attract huge amounts in multiple rounds. And so they see our market or partnering or IPOing on Ames and then coming into the US as a good mechanism to offer those investors that liquidity event, to be able to have a public price, to be open and transparent. And in many cases, and we haven't really talked about this, to learn how to be public. There's a life cycle of learning how to be a public company that we haven't talked about in all of this, right? Early stage companies that are being, from a SPAC perspective or a direct listing perspective, it all seems very fun and exciting because you read about it in the FT, but then you actually do it, and you have to understand that it's not the end of the race; it's the beginning of the marathon. And so there's an entire learning curve as we're speaking to companies. And again, we started at $2 a share when we direct listed onto our own market. We're now at $50 a share as of today, right? We've been through that journey of an early stage growth company to a 600 million market cap company, and all of that and what that entails, and how we service our investors and provide liquidity to our investors is those are the conversations that we continue to have with companies around the world.
Sorry, you go ahead, go on.
Mike, sorry, I was going to say, underpinning all of that, the data and the information is so much better than it used to be. So, at all points across the cycle, there's greater visibility of valuations and who's investing in what at seed right the way through to IPO. And that's not just sort of fragmented local information, that flows globally. So I think, that also helps to make sure that both in the private and the public markets, we are seeing genuine global flows of capital. And also, that sort of traditional cycle of, seed, BC, IPO isn't necessarily quite that straight. You'll get some companies that go from B to IPO. You'll get companies that actually come to IPO with a view to ultimately being acquired by private equity, or doing, or private equity and VC actually using the public markets to stay in, but raise, some further capital. So, and that's all fueled by much better availability of information and data, and that's only going to, continue to accelerate. And that's been really helpful from a growth perspective on AIM, for example, where we see some of our companies that, surprisingly for a growth market, actually 50% of their register is North American capital. So I think all of that's really helpful.
And look, I'm just conscious of the time, and I know we're coming to the end of our allotted time. One thing we haven't talked about, I'd love to hear from each of you on, is what it is within, let's say, the technology and the life sciences sectors, for the purposes of this conversation in particular, those fast growth sectors. What is appealing to the markets? What is difficult for the markets? There was a very to draw an analogy, private equity was great at investing in enterprise tech, right? You know, recurring revenue businesses. That was the tech sector for private equity. PE is now has seen the joke about the value of the consumer internet sector and has gradually been drifting into that. We saw Carlyle buy Jagex Game Studios in Cambridge just earlier this year, which was an interesting play. And I think that we're seeing my own view, but I'd be very interested in the panel's view, is that the markets have been much slower to adopt the risks, the perceived risks of consumer internet businesses, as opposed to enterprise technology businesses. But I do see quite a change coming through now, perhaps driven by fintech, perhaps driven by the EV market. I'm not sure, you know, what the biggest driver is going to be, but to me, it feels like we're right on the cusp. And I know that there's been a few challenges in London. I'd love to hear about New York in terms of just investor attitude to that perceived risk as everybody is learning. I'm going to start with you, Rosh, just to see what you're seeing from the company perspective and how companies are messaging their businesses now in this new world.
Yeah, it is really, really interesting. And I think the shift in, I wouldn't say a shift actually, the slight move in private equity mentality to different sectors, because it's just so, one, it's just so competitive within the enterprise sector, like typical software sector compared to other private equity, and then you're competing with the public markets. There is just a lot of competition in that sector. And going back to how a private equity fund is actually, how it works, they're not in it for massive 100x possible returns on a single entity. And so typically where you see bigger risks in consumer, where you potentially see bigger rewards, that hasn't really been the sector that they've been focused on, because there is so much downside, and turning off marketing spend on a consumer company potentially could be catastrophic. But where we are seeing companies like you say, like Jagex, which does have an interesting model where it's got a sustained title, gaming title, and you've got some visibility to revenues, you are seeing a different investor base coming into it. But if you're looking at it, I guess, from the company's perspective, there is a wall of capital available to you. And what we're seeing is that private equity is coming downstream, and they're potentially looking at companies that are not quite at the profitability stage, and maybe just at that cusp, whereas historically they would have always have to have seen some degree of profitability before private equity would go into it. And so, if you like, the new stage of growth cap was invented, if you like, in the last few years, and private equity is dipping into that, and certain parts of their fund are being able to dip into that. And so everyone's coming earlier into the cycle in terms of where they would normally invest, and they're coming a little bit downstream. And so companies, there's more capital than there are companies. And so companies are in the position of power and control, being able to choose who their investors are, being able to choose the perfect marriage of investors. I mean, this is assuming you have a good company with the right metrics. And so we have seen a shift to control to the company, where they can choose their investors to a certain degree, whether it is private equity, whether it is venture capital, whether it's growth cap, whether it's the public markets. But yeah, it's that control going to the company, and investors are coming slightly more downstream.
Yeah, no, it's a very good point. I very much agree with that. And Jason, as you think about that same question from New York and investor risk appetite, if you like, what dynamic are you seeing at the moment?
It's been really challenging. And again, I think Rush said, right, the right company, a good company. But through all of this, there are so many companies, right? There's tradability, and I think we all offer tradability, right? There's a place where shares can be traded and quoted, and then there's visibility. And I think as you look at the visibility side of the equation with so many companies, what's been challenging is being able to get your story out, and being able, if you're a good company, to Rush's term, to be able to get your story out to investors when there are so many opportunities. I won't say for bad companies, but for bad markets, one of the bad markets, I'll call it promotion, right? There's a big issue in the US and Canada, is around the promotion of securities. And so COVID was an interesting one, because there was a time there when every biotech company was putting out press releases that they somehow were related to a COVID cure. And what does that do for, the spikes in liquidity and investment, only to get, told to remove the press release or to put a promotion flag on the stock. And so I think from an issuer perspective, it's really hard to navigate a market where so much is on social media, the meme stock revolution, the retail investor. It's become really, really difficult to help companies do the right thing to set themselves up for success in that environment. And so we've been faced with a lot of those one-on-one conversations with issuers, what you should be doing, what you shouldn't be doing, what types of advisors you should be working with, which ones you should stay away from. We have a whole list on our market of prohibited providers, prohibited investor relations firms, prohibited news firms. We have a promotion flag that we put when we see a company that's doing something nefarious or that has, insiders that are doing anonymous promotion. It's a really difficult market in the US right now, and one company that companies are learning to navigate.
And Marcus, just finishing off with you, and I know it's something that we've struggled with in London a little bit in the interest of transparency, the public market investor appetite for faster growth technology companies, and historically the European companies have tended to favor New York. It does, I can do a sales pitch for you now, but it does feel to me like the pendulum has swung at last, and that London and Europe generally are coming back into a sort of the direct line of choice, if I can put it that way, and whether it's the full list or whether it's Ames or even whether it's Amsterdam or Paris or elsewhere. There seems to be a real dynamic in these markets and an investor appetite to get this right this time. Is that fair? What are you seeing, and how does that vary between the enterprise software companies and the slightly, let me call them, edgier consumer internet businesses?
Yeah, so I'm certainly not going to disagree with your sales pitch, Mike. Look, I think though what I would say is that even going back sort of 5 or so 10 years ago, I think there's been some misperceptions actually about investor appetite. I think there's been a lot more commentary about whether investors will or won't back a certain sector or company at a certain growth stage. And actually, we've seen good companies, get access to capital. You sort of talked a little bit earlier about sort of consumer internet historically being a bit of a challenge. But actually, you look at companies like ASOS and Boohoo, they've had very good long-term investor support. I think, though, where you're absolutely right is that we had seen a lot of that focus and maybe the slightly higher risk appetite in the small and mid-cap space. And it's great to see that now kind of flowing through to the mid and large cap space, and companies like THG coming through onto standard last year, as you mentioned earlier. And actually, I saw some stats the other day that and I can't remember the exact data points, but there are more pre-profit businesses that IPO than I think people would expect. And I think this also sort of reflects Rosh's comments about private equity. I think the institutional investors are prepared to back the right companies with the right management teams. But I think they do look at has the management team got the experience to be able to deliver on the growth plans. What they don't like is sort of story stocks, but where there's some substance behind that, either because of previous track record or strong management teams or good cornerstone investors, then I think the appetite's there.
Yeah, well, it's good to hear, and I think as I draw this to a close, I will say, certainly speaking personally, but I sense I could speak for each of you in saying this is probably the most exciting moment that the markets have seen for many, many years. To pick up on something that you finished with, Jason, is undoubtedly the most challenging as well. I think we've got some utterly new dynamics in the market. I don't think any of us knew what a SPAC was 12 months ago, and you know, here we are waxing lyrical about SPACs, and it's a big feature of our daily lives. So and there will be lots more of that dramatic activity in the markets in the coming year or two. But it's a super exciting time, and I am very, very grateful to all of you for joining me today and sharing some of your considerable wisdom. It's really appreciated. Thank you very much indeed.
Thank
Thanks
you.
very much. Thanks, gents.
Thanks, everyone.